Hello and welcome to this video in which I will take you through NISM series 8 exam, which is about equity derivatives. I will take you through the chapter 1 of the book, in which we will try to learn various aspects which are already highlighted here. Okay, so we will just go through all these aspects of this chapter, which relates to meaning of derivatives, history of derivatives, significance of derivatives, and risks in derivatives trading. Okay. So let us now start by looking at what is derivatives. So it's very simple to understand. Derivative is a con- contract or a product whose value is derived from value of some other asset known as underlying. So this is a point that we must know, that for every derivative contract to exist, there has to be an underlying. If underlying does not exist, derivatives contract cannot be created. That is what we have to learn. So which are the underlyings that we are talking about here? The underlyings can be many and different, as we can see here. So which are the underlyings that are visible? Metals, energy, agri commodity, financial assets. All these underlyings are required for derivatives contract to be created. Okay, so if you want to create a derivative contract, there must be an underlying. That is the first thing. After that, now that we have got to know about this particular aspect of derivative, that derivatives contract can be created only when there is an underlying. They cannot be created otherwise, right? So if the point that I'm trying to highlight here is that there should be, you know an underlying, okay, for derivatives contract to be created. This is something that you should also note down so that it helps you, right? That's the point. Okay, now we'll go back to the history of derivatives. History of derivatives is obviously very old. We can see that in this book it is starting from what we can say is 20th, sorry, 12th century. European trade fairs, sellers signed contract promising future delivery, and that is important. But from exams perspective, we must know that it was the Chicago Board of Trade which facilitated trading of forward contracts, right? So first it started with forward contracts, and then in 1865 the futures contracts were introduced, right? So this is something which is asked in exam. Okay, so you must know this. The rest of it is more of historical evolution, that how the T-bill future started and euro dollar contract started. So you don't have to kind of put lot of time here in remembering all this. The point that I said initially was valid, that you should know how it started for the first time in terms of futures contract. Okay, but what has happened is that there are many factors which have contributed to growth of derivatives market. So increased fluctuation or volatility, basically integration of financial markets, use of latest technology, enhanced understanding of market participants on sophisticated product, and frequent innovation in derivatives. So what are the factors which have caused growth of derivatives market? If there is a question on this, these five factors must be known by everyone. So the questions may be asked in two ways. Which of the following factor has not contributed to the growth of derivatives, and which of the factor has contributed? So if we know this, okay, we will be able to get a full idea. So these five factors you must know. Indian derivatives markets, how did they start? So we have a history which starts with LC Gupta committee. LC Gupta committee, under the chairmanship of LC Gupta, okay, helped basically in the development of this market. So what happened was that SEBI has set up a 24 member committee under LC Gupta to develop the appropriate regulatory framework for derivatives trading. The committee submitted its report, and then SEBI set up a group in June 1998 under the chairmanship of J.R. Verma to recommend measures of risk containment. So this is how the derivatives market started growing in India. This is basically the starting point of the growth of the market. Okay. In 1999, Securities Contract Regulation Act was amended to include derivatives, and in March 2000, the government repealed a three-decade notification which prohibited forward trading, right? This is the landmark development. This is something that you should know. So basically it is the SCRA which gives the definition of derivatives, and this is what we can see here, right? So government lifted the ban on derivatives and we had derivatives trading which started, right? The exchange traded derivatives started in India in June 2000 with SEBI permitting NSE and BSE to introduce equity derivatives. SEBI approved the index futures contract on Nifty and Sensex, which commenced trading in June 2000. Okay, and then we have a growth which happened, right? So that's very clear. So this is something that everybody should know how the growth has happened. Okay, and we have a exchange called as Metropolitan Stock Exchange, which started derivatives trading in 2013. So I mean, effectively, there is not much trading that happens there, but you must know that, correct? So what is forward? It's a contractual agreement between two parties. This is the definition. So it is a contractual agreement between two parties to buy or sell an underlying asset at a certain future date for a particular price that is pre-decided on the date of contract. So you can see here that this contract that we are referring to, okay, it's a contract which is happening between two parties. What is the contract for? To buy or sell an underlying asset at a certain future date. So maybe you are planning to buy something on a future date. Okay, the price is agreed upon today. Okay, and the contract actually gets completed on a future date. That is what is forward, and both parties are committed and are obliged to honor the transactions irrespective of the price of the underlying asset or time of delivery. So remember, the price is agreed upon today, so the contract will be executed um, today itself, but the settlement will happen in future, right? And that is something which is important for us to know. So futures are forwards are basically an OTC contract. OTC means over the counter. Okay, over the counter again means it does not mean there is a counter. Over the counter means the two parties have traded mutually. It can be on a telephone, it can be through an email, it could be a proper contract that can be signed on a piece of paper, right? So we have futures contract and then we have forward contracts and then we have futures contract. Futures is similar as forward, but only one thing is that it is traded on the stock exchange. So forward is not traded on the stock exchange, but futures are traded on the stock exchange. And they are standardized contract that we should know. Of course, the detailing of future is in subsequent chapters, but here I am just giving you a kind of a idea, right? Futures are also standardized contract in terms of what is their lot size, their maturity date, etc., so that they can be traded on exchange. So if you want to trade something on exchange, it bound to be standard. Okay. Then we have the third contract, which is options. So option is a contract in which there are two parties, but only difference is that the buyer has the right but no obligation. This is what differentiates options from futures. In case of futures, both parties have equal roles and responsibility. In case of option, buyer has the right but not the obligation to buy or sell an underlying asset on or before a stated date and a stated price. So I am a buyer, you are a seller. I have the right to buy or the right to buy in this contract which has been done between two parties on or before a prescribed date. Okay, but I am not under obligation to buy, which essentially means that if I do not buy, okay, the contract will still be completed, but only difference that we will experience is that the buyer, since the buyer has not executed the contract, the seller will receive an upfront payment made by the buyer, and it is called as the premium. Okay, so buyer pays to the seller premium in this contract. Okay, then we have a swap contract. Okay, so swap is an agreement between two parties to exchange cash flow on a future date. Swaps are a series of forward contract. That's how we call swaps as. So in forward contract, only one time exchange of cash flow happens, while in swap, it can be multiple times, right? Depends upon how the contract has been designed. Okay. Who are the participants? You have hedgers. Hedgers are one who want to mitigate the risk. Okay, so they face risk and they try to mitigate the risk. So hedgers essentially work on risk mitigation. You can mitigate risk, okay, by entering into derivatives contract. We have corporations, investing institutions, and banks. All of them act as hedgers. Then we have speculators. A speculator is someone who will basically see how the price is moving and then accordingly take a call. So speculators operate on price movements, right? That is what is their job, correct? So they try to predict the future movement of price and based on view take positions. They can be buyers or they can be sellers also. And derivatives are preferred over underlying asset because they are leveraged and less expensive, and they're faster to execute transactions. This is the three things that you should again note, right? That why derivatives are preferred over spot transactions, or cash transactions. So this is the point that I have highlighted. And then there are arbitrages. So arbitrages basically exploit difference in the price between two markets, okay, and then do a transaction. So here there are two markets which are spot market or cash market and derivatives market, right? So arbitrage originates when a trader purchases an asset cheaply in one location and simultaneously arranges to sell it at a higher price on another location. This is how the arbitrager typically work, right? This is what it enables, correct? So this is what we should know here. So what are the three key players that we need to know? So we need to know one, what we have already defined as in terms of the hedgers. The second is the speculator, and third is the arbitrage. All these three we must know. Why should we know them? Because if we know them, we will understand not only who they are but what is the role that they play for us, okay? So you must know three key players, okay? This is a kind of a note that you should make, and these three key players and what role do they play, we have already seen their role, correct? So let us move to the next point now. Okay, what is the next point? What are the types of derivatives market that we have? So derivatives markets are basically of two types. One which we call as the OTC, okay, which happens typically between two players, okay, and OTC, and there is something called as an exchange traded transactions also. So we have OTC transactions and we have exchange traded transactions. Exchange traded transactions are much more structured. Okay, so the transactions either happen, as I said, okay, between the parties themselves on OTC, or sometimes these transactions are also done on exchanges, right? But remember one thing, that forward is always done on OTC, swaps are OTC, options can be OTC and exchange traded, but futures are compulsorily exchange traded. So four transactions are there that we are referring to. All four here which are mentioned, okay, they can be either done on exchange or can be done OTC. So forwards, as I said, will always be OTC. That is the point that we need to know. Futures are exchange traded, huh? This is what you should know. Options can be both. Options can be ET, which is exchange traded, and OTC. Both are possible. And swaps are OTC. This is what we should know. If we know this, we will be able to understand the full concept. Right? So we have looked at this point now. Let us move down and see further, okay, other aspects of derivatives. So we have seen the types of markets, okay. Now uh, in the types of market, if we see here, okay, we will get to know that there are certain aspects of risks which come from OTC transactions. OTC transactions are basically tailor made to fit into specific requirements of dealing counterparties. That is one point. Management of counterparty risk is decentralized and located within individual institutions. So whatever is the risk that you have, it is for each trade with each entity. There are no formal centralized limits on individual positions, leverage, or margining. Of course, if you are a bank and you are trading, or if you are a mutual fund and trading, then the regulator will put a control, no doubt. But generally, there is no such formal contract. There are no formal rules or mechanism for risk management to ensure market stability, integrity, and safeguarding the collective interest of market participants. So, uh, we have to note down all these five features. Okay, so you must note down all these five features of OTC market separately in your book, so that whenever there is a question related to that, you are able to answer. Okay, exchange traded transactions are very standardized, and there is an entity called as clearing corporation which guarantees the performance of contract. So basically, clearing corporation is taking care of that particular role, which is not there in case of OTC transaction. That is again an important point to note. What is the significance of derivatives market? Is the second, or rather, the next point that we need to know. So derivatives market have multiple role to play. They help in price discovery. They enable transfer of risk. Okay, so if you are a hedger, you can reduce your risk here. It enables shift of speculative trades from unorganized market to organized market. Okay, that is another benefit which is there. And derivatives, there's a risk management and surveillance of activities. Okay, uh, of various participants in unorganized space provide stability to the financial system. Those are the benefits, obviously, of derivatives market. What are the various risks faced by participants in derivatives market? So this essentially means that if you are a participant in derivative market, and please remember that there are three participants: hedgers, speculators, and arbitrage. Of course, you can call them as investors or by any other name also. So what are the risks that you will face? So you may face counterparty risk, which is the risk arising from the default by the other party. You will face price risk because price keeps on fluctuating. So you can see here, these are the risks. So please note down all these risks which have been mentioned, okay, because these are typically asked in questions. You have liquidity risk if you are not able to sell the contracts faster. And then you will have operational risks, okay, which is basically arising from fraud, inadequate documentation, and all that. So market participants should carefully consider whether such trading is suitable for them, and market participants who trade in derivatives must go through model risk disclosure document. That is something which is recommended. Everybody should go through this. It is issued by the exchange, and all prospective participants should read this document before trading in the capital market, cash market, or FNO segment. FNO stands for futures and options. I'm sure you know that, but I've just told you here. Okay. So now that I have told you about the chapter one, okay, chapter one basically was just having some key aspects of derivatives market, which you and everybody who is preparing for this exam needs to know. So we have gone through the basic aspects of it, right? Now, obviously, you will be asked multiple choice questions based on this, which is there in the book also. But you need to note down all the points that I just told you, so that you can prepare for the exam in a better way. So this kind of question you can expect. Of course, these are sample questions and not the entire question. So I hope you were able to get the concept of derivatives. What does it mean? How did derivatives grow? It's basically their growth journey. Okay, who are the key players in derivatives markets, and how they have helped the derivatives markets, and difference between OTC and exchange traded products, and key functions performed by derivatives markets. So please keep on watching this channel to understand the concept of derivatives. We will be taking up other chapters. These are the questions. Chapter 2 I will take up in a separate video. Of course, that is a lengthier chapter and covers more aspects. Okay, but I will come back with understanding of index in some other chapter. Thank you for your time, and thank you for watching this channel. Please do like this video and subscribe to the